Hi everyone, let's hope all of you are keeping safe during these difficult times. Today's topic is investment. We're going to be talking about different types of investments. And let's start with the with minimal risk investment, or basically no risk investment. That is called GIC. Anybody can walk into a bank or a financial institution and ask for a guaranteed investment certificate. Guaranteed investment certificate gives you principal guaranteed. So if you put in $10,000, that $10,000 is guaranteed. The interest that you earn on your GICs is based on the amount and the prevailing interest rate. So right now we are living in a very, very low interest rate environment. So your GICs are not really going to pay you any a huge interest rate. As a matter of fact, a lot of the GICs are now paying 0.5, 0.75, 1%. If it's a big amount, it'd be 2%, 2.5%. And depending on the bank, the rates can vary. But for people that want security for their money, safety for their principal, GIC is the option. This is something that used to be very popular, say 30 years ago. I remember buying a GIC in Canada for 8%. Canada Savings Bond used to pay very good interest rate long time ago, but not anymore because we're living unprecedented, very, very low interest rate environment. So that's number one. And GIC may be something that is good for a lot of us Canadians that don't want to take any risk with our money. A lot of times people say, well, what is investment? What is investing in mutual funds? And I say investing in mutual funds is almost like you walking into a supermarket and picking and with a basket and picking things that you like. That's how simple it is. So imagine the whole world, all the companies are basically selling themselves and saying to you, come and invest money with us. And you invest money into the company based on your risk tolerance, your personality, your goals, your objectives, and your preference, basically. So a lot of times, as a financial advisor, I would look at clients, time horizon, personal and financial circumstances, their risk tolerance, their current net worth, their cash flow before I make any recommendations of any sort of investments. So when you go out there, and one more thing I want to explain here is the types of investment out there. It would become very clear to you when I take you through debt equity. What is debt and what is equity? So debt is when a company starts out and says, you know what, I have put all my money that I had, but now I need to borrow. So there are two options that companies have. Option number one is I can borrow someone else's money, whether it's public, government, corporations, and invest it in my business and pay an interest rate, a promised interest rate on that loan. So that is called debt, okay? And debt is always less risky because you're not part owner. You're not owners of this company. So if you don't own any part of the company and you've just given your money for investment to this company, that company has to make sure the company runs, the business does well, and pays its obligations by paying your debt back. The other type of capital raising that companies do is called equity raised capital. So the other type is when business starts, needs money for growth, goes out public and says, I am selling part of my company and I'm open to having more owners of this company, but just myself. So come and buy ownership. So when you buy equities in a company, you're basically saying I'm part of the risk, which could bring me profit or loss. Okay, so that's the difference between debt and equity. Now, when we talk about mutual funds are actually made up of all three investments. There's part GICs or secured investments like T-bills, commercial papers. There is another part that is made up of debt and equity. Now, the mixture of these three, so guaranteed investment certificate, T-bills, commercial papers, then bonds, corporate bond, and government bonds. And on the other side, you have equity, which is ownership in different companies. So based on client's personality, I would choose if the client should be invested in Canada only, in financial services only, in commodities only, in infrastructure companies, or this client would like to go out and invest internationally. So let me tell you how I choose where my clients should be invested. And of course, client's preference always is number one, within reasons. So when I talk to a conservative client who says, you know what, I can take a little bit of risk, and I look at their situation, I know they have safe jobs, stable jobs, their cash flow is good, they are paying their mortgages, they have invested in some properties, they have a business running on the side, and they have liquid investments as well, and they want to take risk. These are the guys that say, you know what, if I invested 100,000 and it goes down to 90 or 80, like 2008 market went down by 38%, and some people were okay. Like, I was fine with the investments that I had and I didn't touch them. And by not touching, I actually came back up by 2010 and I gained a lot more. However, I'm a risk taker, okay? And not everybody is a risk taker. So where you invest for your client depends on their personality, their circumstances, and their preference. So a conservative client may be someone who says, you know what, only 20% into equities, and the rest 80% should be in cash or bonds. And we call it a 3-bucket approach to investing. Also important to look at this approach, which is called 3-bucket approach, is because if, let's say, client runs into a situation like today's situation, COVID-19 situation, if that happens and the client has $200,000 and it's divided in 3 buckets, I don't need to touch the equity side of his investment if he needs money. I can quickly go to the secured basket, which is not invested in risk, which is not invested in companies whose stocks may be low right now, price-wise, and he may end up losing by cashing out. I would ask that he withdraws money from the cash bucket. So anyhow, this is what I wanted to talk about investing, and I hope debt versus equity is a little bit more clear to you. I had a question about should we be looking at robo-advisors and iShares and online accounts? Yes. So it's a personal preference. Personally, if you're working with someone like me who's a financial advisor, I would give you a budget. Okay, every year you want to go and play stocks on iShare. You can open up an account with any institution, and you would be asked which stock you want to invest in. You can go ahead and put your money right into that stock. However, when you play individual stocks, they are more risky. That's the riskiest investment. And regardless of which stock you choose, if you're choosing only 1 or 2 or 3, and I have people that say, well, I only play with the top 5 companies in the world and that's it. Well, if those 5 top companies run into trouble, or when the stock is down and you need money, you may run into a bigger trouble. So having a budget every year to play your own stocks is a better idea than you putting all your lifetime savings into risky market. I call it not investing all your eggs in one basket. All right. Time value of money. Another to remember is that the more you delay saving money for your future, the lower the value that you're going to get at the end. Okay. So for example, a 25 years old, when he starts investing $500 a month, and let's say another client who delays it till he's 45, at 65, the one who started at 25 would have 3 times the money. Okay, so that is the compound impact of you investing early, which we call time value of money. So the earlier is better for anyone to invest. And like I said in my last video message, you should be putting away 20% of your income at any given time, at any given income level, and in any given market. Okay, so you don't need to try and time the market. You don't need to look for that right moment to start investing. Right now, as you know, a lot of the companies are down, their stocks are down, and people call and say, Seema, is this a good time to invest? I say yes, because a lot of the big companies, their stocks are down by 20-25%. It's a good time. So Seema, is my money safe? Well, that's a tricky question, because if these companies further go down, I can't guarantee your principal, but I can tell you that, looking at historical returns of these stocks, anytime they go down, they come back up even higher after the recession or after the market crash. So based on that, I can say, yes, it's a good time to invest. But again, looking at each individual situation, income, personal and financial circumstances will dictate as to what investment you should be in and how much you should be investing. When people ask me, where are you invested? I tell them TFSA and RSPs. Is that correct? So I just want to say for the record, when people ask you, do you invest? Do you have investments? And you end up giving your account names. So TFSA, tax-free saving account, is a name that CRA has given to you. It's a tax-free vehicle, an account where you can invest your money and not pay any tax on. But that's not what people are referring to. What they're probably asking you is, where are you investing? Are you investing in GICs? Are you investing in mutual funds? Are you investing in stocks? And if you're investing in stock, they might ask you, what's your preferred stock? Where do you invest? Do you invest internationally or locally? Okay, that's another thing. Clients have preference. A lot of my clients say, I don't want to go outside of North America. Now, we do know that 60% of world economy is within North America. So a lot of the portfolios that I manage, 60% of their money is sitting within North America. But then there are international stocks that give you great value for your money. But again, it has to be based on your risk tolerance and your preference. If there are any questions, feel free to send me an email. You'll have all the contact information right on the screen. Thank you, and enjoy yourself. Enjoy your time off with family. Stay safe, and these times will go away, leaving us stronger. Thank you.